glad to be with you guys. What I would like to talk to you is portion of the work that we have done in collaboration with several people across the campus around making a business case for sustainability and valuation, sort of, proposing a new way to evaluate technical innovation, particularly related to the sustainability and resilience. Again, thanks for the invitation. Overall, when I'm looking at the past 16 years, ever since I started as a assistant professor here at Georgia Tech, over the past 16 years, I have been working on some sort of, economic decision analysis type problems. And if I put it as construction infrastructure economics, that's kind of an umbrella. A portion of that is investment valuation that I'm going to talk to you about. That is mainly making a business case for investment in sustainability and resilient infrastructure systems, talking about cost-benefit analysis. I have done lots of work around areas of econometrics and data analytics application into cost of infrastructure. And this is a timely topic. I'm not going to talk too much about that today, but we are in an inflationary environment, but the construction and infrastructure cost in this country particularly is much more than anywhere else in the modern societies, in the sort of, OECD type countries, in top 20 economies in the world. US infrastructure and construction costs has been notoriously high, productivity has been low, and all of the other things. So I have done a lot of work and continue working on the cost analysis, which sort of get to the deployment of the sustainability. So you will see an interface of that with some of the investment valuation talk that I have today. I've been working with many owners of major capital project on infrastructure project delivery. Most interestingly these days, working on alternative project delivery and form of public-private partnership in a lot of nuances in the sustainable developments. For instance, electric vehicle charging stations. Most recently also working on the hydrogen fueling stations. So these are sort of the new funding streams that comes, and the US federal governments and of course the states would like to see the network expands, but at the same time they don't want to take the ownership of that because A, that's not the domain that they have any expertise into that, and B is really it's a private sector. It should be like a private sector. It's not. I mean, if you look at the history of how the gas stations opens, how we get energy to the public, and particularly in this case on the transportation, for instance, when we are looking into that. So a lot of work around infrastructure delivery and issues around that. And the last pillar of some of my research is the nuance of the artificial intelligence and data analytics, particularly application of that into design analytics, design management. We have done some good work around that recently. We received another NSF grants to look at AI applications for design development, sort of automating certain design tasks and looking for expanding horizon on that. But, the cost benefit analysis, particularly investment valuation, has been the core. And I thought, when there was some discussion in the summer about presenting for one of the Brook Byers seminars this year, I thought, talking about investment valuation. And by the way, I'm hoping those who are here, please stop me at any point, because we know that this is a place that we want to receive feedback. We want to connect. Maybe you have some ideas, some problems that I could collaborate with you, or you have some ideas that I may be able to bring and deploy that further. But let's talk about investment valuation. And I'm focusing on the building side of that, coming from the building construction and College of Design, sort of this movements towards green building, sustainable building, energy efficient building, and deploying renewable energy into the building. One thing that there is a demand out there is a new set of tools for making investment decision. How you make a business case for sustainable building, green buildings. And I'm going to argue, and there's some slides coming up on that. What I'm arguing is we always look at the wrong metrics. A lot of, building appraisals are still not considering the full value of investment in sustainability. For two reasons. One is the lack of data, lack of performance data, lack of actual performance data, how these systems actually functions. And B is lack of a proper methodology. That's A and B goes hand in hand, but lack of proper methodology, which is still a lot of issues. We consider that as a one-time decision rather than a range of decisions, holding an option, as I would like to call that, a real option on investment, which basically timing and a scale of the investment would be a question. I'm going to provide some examples around the solar and solar energy, the photovoltaic energy deployment, and how we can scale it up in order to enhance the success rate for this type of investment and help them to spread out. And I finally, kind of make a connection to the whole discussion around greenhouse gas emission and abatement strategies that can be deployed. And buildings, of course, as you all know, is at least responsible for 40% of that. So we are in the midst of a lot of support from the government. When you look at the Inflation Reduction Acts and also looking at some of the IIJA bill, bipartisan infrastructure bill, all over the place you have commitment to the building energy efficiency, whether it's renewing energy for rethinking of the energy sources for K-12 or other type of investment in the energy efficiency infrastructure or renewable energy, whether investment in the manufacturing side of that. So when we are looking at the public and private sector investment and interest, over the past 2 decades, it continued to increase, and we are noticing the largest injection of the monetary investment into the world building stock. And it's not just the US, of course, you are more aware of that. Across the country, we have these issues. So I like to borrow this. This came out of our own Professor Brown, and I kind of borrow and kind of a little bit manipulate with the barriers. As you know, she has done a lot of policy work around sustainability. So, and I found for the most part it applies to the sustainable building, green buildings. We have several conversation with Professor Brown and other policymakers. So you can see this is truly a multidisciplinary problem. It's not one discipline. Yes, there are technical issues. That's our friends in mechanical and electrical engineering. They're trying to get it more and more, more energy efficient, more next generation of the photovoltaic system, which are more efficient, more functional. We need to work on that, and there are certain market structures, but there are a lot of business barriers into that. Whether it's licensing, whether it's the rule of the role of private sector and public-private partnership that needs to happen, like the kind of things I mentioned, the hydrogen fueling station, for example. That's one of those things that we see, public-private partnership, and a lot of IP transactional costs. That's as a barrier, but mainly I would like to talk about cost effectiveness and some of those fiscal barriers, because no matter what the technology is, we always have that one. And we have sometimes competing technologies, and how we would make a better decision, more informed decision by creating some good portfolio that overall consider the market risk, consider the technical risk, consider all sorts of benefits and other stuff. Again, multidisciplinary, I categorize that into 6 type of barriers and 6 categories of barriers and 20 types of barriers. But I owe that to Dr. Brown and her work in that area. Any questions before I move forward? Anything? All right. So one part
Here,
related to,
oh,
yes,
sorry.
please.
Sorry, apparently our mic was off. Could you talk about the IP column here?
Again, not my areas of expertise, but I'd like to hear from you on the business side of that, from private sector. What my understanding is, a lot of technologies getting that proprietary protection and price tag that comes with that, and sort of protection of that in order to be deployed across the world around the country. So, and a lot of transaction costs associated with that in terms of protecting that. I think this is something normal, like any other new technology and new things that we always have, including some of the sustainable technologies that are available out there. They're protected, and that acts as a barrier. But again, that's my sort of limited understanding of the whole patent law and the intellectual property around that. But if you have some experience on that, I'll be happy to hear.
No, I'm not an IP person either. That's why I was asking.
Yeah, so in our industry, that's also true in a way that maybe not so much in terms of the patent, but a lot of these projects, the architects, engineers behind some of these building projects, they are not available for everybody. They're not available for any communities. So that's why you see a lot of this sophisticated one only with the clients that can afford. Like, for instance, Georgia Tech, or some of the higher educations, or some of the top healthcare. I mean, they have the financial resources. They have access to some influential donors that can afford investing in some buildings, like Candida building, for example. But not everybody has that. So in order to deploy that, so intellectual property is in our business, in the architectural engineering construction business, in infrastructure business, means these are top-end, high-end consultants, and they're not available. I mean, for whatever reason, they're only working with some high-paid consultants. So we have these issues, like, for instance, a lot of good stuff happening in home buildings, but only applies to some selected high-end luxury buildings, luxury home builders, but the rest of us, for one way or the other, cannot use that, because it has not been deployed, and the transaction cost is there, which is, kind of one can consider that as a market failure, if you will. If it's socially good, why not we deploy that? And part of the programs that now, like, for instance, Inflation Reduction Act, for instance, they try to bring it to the picture. Like, for instance, there is a program for the K-12. So especially if you are in high needs area, the government is paying for not only deployment of technology, but also planning and design of that, in order to get you up, I mean, sort of uplift those high schools, middle schools, elementary schools in the low income areas, which they cannot even get to the entry level. So they don't have any financial resources to do a full energy audit, for example. But yeah, I mean, if I would love to look into that, but haven't done any studies particularly looking at the IP.
Thank you.
Thanks. So what we are challenging here is the status quo of the ROI, NPV, or payback period. We believe those metrics are going to stay there, but they need to be expanded. They're limited for this particular type of movements and evolving technologies, with a lot of market uncertainties in terms of retail price of electricity, in terms of technologies that coming. For instance, looking at different generations of photovoltaic systems, and the things that are now people in our labs at Georgia Tech, for instance, they're working on the next generation. When they become available, their efficiency, their effectiveness, actual performance of these technologies are not well established. So the metrics, if you use the traditional metrics, probably undermine the value of the investment, and an owner or investors would not capture the true value. So we want to go ahead and propose looking at these investment opportunities as real options, as the options that you might have invest in that at some point when it is desirable. So that's why, the practical limitation that we see, and in the literature for the sustainability evaluation, we always see some of these issues. So because the intervention timing is not part of that NPV valuation. Yes, we have some expanded NPV, net present value calculation, that you may want to consider that, but we always run to either overinvestment or underinvestment, which is both of them are not good for the general market. And particularly as we talk about using taxpayers' dollars for those kind of investments, which has long time horizon, especially when we're dealing with the institutional owners, corporate campuses, university campuses, those kind of long-term institutional owners, they serve them not really well if they use NPV or ROI. So that now or never assumption is never going to be a good way moving forward. So we like to see that these are all options, and similar to, we're using the financial engineering terms or borrowing mathematical finance. It's like options on some assets, option on some stocks, for example, a call option or a put option on a stock of IBM or Amazon or any other corporation, but borrowing that concept and forming the analogous measure, which is called the real options, which are investments on the real assets, real projects. And the challenge is the real projects are typically not traded widely across the board. The problem we have with other sort of, maybe look at that commodities and stocks. I mean, any one of us here now, we can trade those, as you're listening to me on your phone, you can go and trade some option stocks. I mean, you can do that almost instantly, and there is a large market, complete market available. But we cannot buy or sell energy efficiency type, contracts on a building or a corporate campus or deploying renewable energy. So it's not enough market for that. And therefore, since the performance is not there, we don't have the data developments in terms of bringing the actual measures into the practice. Therefore, we need a different methodology. So that's why the real options are sort of, exclusive type of investment. But the point is, like, similar to the financial options, we need to look at investment typing and investment timing, the time of investment, the scale of investment, what the scale you go in would be a good approach, and understanding the risk. And the risk here, we have technical risk that needs to address, which is building energy efficiency, building energy simulation can help us on that. So this is getting into the technical fields. That's why we need, architect, engineer, construction folks understand that, which is the design risk, construction risk, and of course, we never have optimal operation and maintenance. That's another area that I'm going to touch a little bit, but I've never done extensive work on that except a few pieces here and there, which is a lot of good things happens on the operation. So we are dealing with an asset that you kind of have some ideas what condition it would be. So the underlying condition on this investment, which is your energy saving benefits or renewable energy production, that's subject to uncertainty. So that's technical risk in this project would have, this real project, real option would have. And then you deal with the market. The market is the fluctuations that you see in the retail price of gas, retail price of energy, and other sources. The fluctuations that you see as we see more prosumers in the market, like not only just consumers, but there are also producers in that. So we see that front as well. So it's becoming a pretty challenging problem as far as the underlying assets and the condition of that in terms of uncertainty analysis. And that makes it a rich problem for the real options analysis. So the view that would like to propose here is that flexibility in investment, timing, and a scale of that. And arguing sometimes delaying the decision might be a good option. or building a portfolio of the solution would be a better options for the investment. And that's changing the perspective of the investors. So you might delay investment or reduce your adoption cost when you wait for stricter environmental regulations comes to the place. Sometimes there are technologies that you're really not sure. So investors might pull back and say, no, I want to see how these things work, how these things play out. Sometimes being first in that adoption may not be the best idea. So yes, Georgia Tech, we went all the way with the Candida building, for instance, but we got to at least acknowledge that this is like 3x we paid for it. Can everybody else do that? Probably not. But while we went into that, we dropped that cost for others. That was the story happens on a lot of these lead buildings. Some early adopters pay that price, but you cannot accept everybody does that. And part of the government support that now goes into the sustainability and resilience type projects is we're going to go in on behalf of the market in order to create some test beds and then move forward, bring the cost down for everybody else. But it's quite normal that everybody kind of wait and see what would happen. A lot of issues that happens on the price of electricity, price of other energy sources, and the fluctuation that you see. And then, of course, always incentives. Like today, we are talking about sort of, those post-pandemic economic incentives that, almost $3 trillion worth of investment comes to the infrastructure. Part of that goes, I think almost all of that are trying to resolve some form of energy challenges, either directly or indirectly. Like even investments in transportation and transit, they try to, as a byproduct of that, we are bringing down our carbon footprint and the use of energy. So one way or the other, we are intervening on that. And that's another way now the adoption costs could go lower compared to what we had previously. So as a motivation example, sort of, I would like to talk about the solar ready homes, which is now commonly deployed especially in the mountain states and the western states, like in Colorado. If you want to get any permit for a new house or you're doing significant renovation, anything above 600 square feet, you need to show that this building, this structure is adequate enough for eventual deployment of the solar energy. Like you make your structures, you make your electrical outlets in a way that is adaptable for future adoption of the solar energy. You can do it immediately, or you can at least build that. This is now part of the Colorado building code, for example. In many places across California, they have that because they know that's going to be a winner on the long run. If you are short in terms of funding and financing, or for whatever reason you don't want to deploy that, fine, but at least the structure needs to be there in order to future owners of that facility or you at some point deploy that. So that's the whole concept of solar ready homes, which is not killing that option. One of the things that we talk about that in the real options, particularly real option in systems, you want to have a flexible system. You want to have a system that you can deploy some of these energy conservation measures and renewable energy. And one of the easy ones is sort of this module of plug and play of the solar panels. So that's something, I believe regulators across the country should make a note. What other things we would like to see in building codes in Georgia, in Texas, and across the country? Because, and trust me that, if, especially when it comes to the building and infrastructure, the incentives comes from the top. So it's either in the code, either the owner asks for it. If not, the contractors, for the most part, and even the designers, do not have the incentives to provide that. For the most part, I'm saying that, I'm not generalizing, but 95%, I would say, if it's not mandated, if it's not in the code, you won't see that. So we have looked at some studies across the board. Over time, we notice how changes in the building codes, like particularly in the Metro Atlanta area. If you look back at 60s and 70s and 80s, that for the most part, there was nothing as far as the building energy code or anything as far as energy code into the building, particularly residential home. So you look at those the performance of the energy performance of those buildings with the ones that built in 90s and early 2000 and 2010s. So you see same square foot, but tremendous energy performance because of just deploying those energy intervention. So that's something, we like to see more of that, and the real option platform provides some opportunities on that. So the goal here, just proposing a new approach, and it's going to be a complex problem. So it's solved by the dynamic programming type problem. So I show a little bit of the formulation of that. I'm not getting into the details. The details already described into some publications we have, but we really want to show the risk profile of the investment and how it is changing by incorporating flexibility into the calculation. So here is the framework.
Babak, can I stop
Yes,
for a
please.
second? The solar
Please.
ready is a very interesting example because it gives you the option of adding it later. So I guess that's the real option. What are some other things in either residential or commercial buildings that have the same feature that you can prep it and then kind of launch it later?
Batteries is another example that we are seeing in the building industry. Batteries are going to be a huge thing, but to your point, unfortunately, not so many other things. And the reason is most of the construction that we are dealing with is primarily sort of a stick building, which is that one-of-a-kind project, and it's applied also to infrastructure as well. But we see a movement towards more modular construction, which, especially these days because of the labor shortage and cost of accidents and all of that, has become, again, more popular. So modular construction is good examples of that. Think of any hotels. So we have cases that each room of the hotel or a patient room in the hospital, for example, the whole unit can come as a module, and you just do the installation, sort of a Lego type of things that the kids play with that, and some adults love to do that as well. But unfortunately, the construction infrastructure industry is not that much into that, unfortunately. So the examples are not so many. But with the advances that we see in the modular construction, we can see more info, because then if there is an issue, you come up with something that is a better product, you can just change that module. You bring a new module from offsite, from the offsite construction, from the fabrication places, and just change that. I see some innovation as far as some self-healing materials and embedded sensors, like self-healing concrete, self-healing pavement, but a lot of that unfortunately is still at the earliest stage. Michael might remember that we had some conversation with folks in Department of Energy ARPA-E program. They're actually very interested. I know I was not able to help them much. We connect some people at Georgia Tech with them, but Department of Energy, I can tell you, to my understanding, and Michael was in that those couple of meetings that we have. I mean, they had blank check for supporting the ARPA-E program, for supporting this kind of perspective, life cycle perspective, like reuse of facilities, reuse of infrastructure. Because right now, what we build for the most part is, we just build it for service life of 20, 30, 40 years. And then after that is obsolete. You have to knock it down and build it over. So not much of a recycling and reassembly, reuse. So if somebody has some good ideas and scale it up with the good construction engineering methodology and supply chain integration, yeah, I can tell you, not only Department of Energy, the industry is also interested in that, but I don't see examples of that, unfortunately, not too many of them. But I see increasing
So the solar ready
interest.
homes would be the one example where this is the most suitable right now. I was just wondering if,
Yes,
as
yeah.
Georgia Tech is building out new things,
Yeah,
are
yeah.
there some ideas to bring to the attention of Georgia Tech in terms of making its facilities future ready in certain ways? Perhaps more in the area of using sensors and data in ways that might still be evolving and are technologies that are not mature yet, but we can see that they will be in 5 to 10 years, for example.
Absolutely. I'd love to hear more about that. That's kind of, music to my ears. I can tell you some other examples in terms of some issues related to design. For example, LAX airport at LAX, they build their, I think it might have been finished now. I didn't travel to LA recently, but they were in the midst of construction of the new car rental facility. For some of us who travel to LAX, you know that it was one of the airports that are nightmare. You want to rent a car, you have to get on a bus and it takes you different places. So now they built that Conrack, which is the monorail that gets you from the airport to the car center. But all of these things happening, that what would be the future for transportation? So we see increasing use of Ubers, and also the Los Angeles in particular investing significantly into the transit. And there was questions at the beginning about building this car center. Yes, it's absolutely needed for today's demand, but what would happen in 5-10 years? And by the way, this project has started before pandemic. So what happened during the pandemic is actually proof that some of those thoughts would be actually good. What would be the future of the office spaces? These are the things in New York City and some other places, and even in Atlanta, commercial office. So that rental facility is structurally prepared to be converted to some office building or even affordable housing. So it's designed for that type of rental facility for today, but it can be converted with minimal cost into some apartment buildings, office building, retail space 5 years from now, 10 years from now, 15 years from now, when the demand was not there. So yeah, I love to see what Georgia Tech is thinking about that. We're all talking about the future of education, and we are talking about future of office building. Yeah, you got to consider that. There are a lot of these issues happening, and unfortunately, it's not easy to convert. Even you might think a structure is a structure, but a lot of things go into the interior construction that makes and prohibit some units to be converted from commercial to residential or vice versa. And by the way, that's absolutely needed as we are changing the way that work is conducted, and also the rising challenge of affordability. So which, some other topics. Yeah. But yeah, good point. I mean, yeah, if you're asking me all of these, what you mentioned, all of these sensors and embedding sensors in infrastructure and in the building construction, yes, we have a long way to go. And we know that the building automation system and building energy management system, they need to be retooled for that. And particularly, a lot of these things that you see on this slide, particularly the areas related to the building energy performance, we don't have any good idea about that. The models needs to be calibrated. So you run the energy simulation model, but it needs to be constantly calibrated in order to provide you the real picture of what's happening. One of the reasons that you and I can go out and immediately price a company or price a stock or anything like that. That appraisal happening because you have so many data points from that company. Every quarter, they give you their balance sheet, they give you their income statement, they give you their return on assets, returns on their people. So you have so many KPIs of that company that you can make a decision on that. But if I walk to your building, I don't have any idea. The best that is happening these days, they just ask, okay, show me the utility bills, how much you're paying. That's it. But what you're in, what it takes to become more efficient, what it takes to become, I mean, what areas needs more attention, all of that, unfortunately, is not available, and you need a rigorous audit before it comes available. So therefore, that's a barrier for investment valuation. We talk about energy price, so and the path that it takes. And by the way, you know, if you look at the Energy Information Administration, EIA, they were always wrong. I mean, one thing short for that, you know, that as far as the uncertainty about the price and other things, so you can look at to that, and their historical records also available. 20 years ago, they were predicting something else. 10 years ago, they predicted something else. So they have scenarios, most likely average kind of things, and then worst case, best case. Yeah, nobody knows. And there are a lot of innovation that's happening. Every time that we feel that, you know, sort of, you know, this is particularly true with the oil and gas industry, they always come with some innovation that prove that, I mean, like we had fracking, for example, or we had some better ways that they can bring down the cost significantly. So once you rule them out, they come back. So this is happening, at least what I observe over the past 15 years, looking at that. So therefore, a lot of these projections are not accurate. So there is safe to say that there is uncertainty around that. And of course, cost of new technology. So when we put all of these uncertain variables, we are dealing with a timing problem that looking at two options: immediate deployment, because you're losing opportunity on energy saving and renewable energy profit, or wait and see option. Let's defer the investment to the next period, or let's invest in some other low-hanging fruit maybe. So every time I go through this slide, it reminds me of, you know, several years of collaboration with Gottfried Eigenbroich, rest in peace, you know, passed away a few years ago, was a giant in the building energy simulation. So he was the one quantify uncertainty about all of those building energy performance calculation. So before that was just sort of, you know, point estimate of what this intervention means. But, you know, he brought all sort of, you know, uncertainty from demand, from actual performance, workmanship, the performance of the technology, and all of the other factors that needs to go into the simulation engine in order to create future path of the energy demand in that building. So what we have now is considering all sources of uncertainties. Some of them are urban effects, some of them are building level, some of them are environmental conditions. So characterizing uncertainty that would happen after deploying certain energy performance measures, energy conservation measures, or renewable energy. And from the price of electricity and gas and other things, for the simplicity of the modeling, I use a geometric Brownian motion, a binomial lattice version of that, which is a discrete version of that, discretized model of the geometric Brownian motion, which serves the purpose, particularly help us solve some of these dynamic programming problems in a closed form, but also is a good platform and a good forecast that you can look into that. And amazingly, when we're looking, for instance, on the photovoltaic system, the batteries cost also, I've recently done some work around that. The economy of scale, economy of mass production, you will see this exponential decline in the cost. And that's been amazing. And I've seen that across the board with many technologies, and it's also applied with, for instance, you know, what you see here is the level of production that we would have on the photovoltaic systems. And the whole global supply chain that we have, once the technology becomes proven, once it passes that proof of concept and went for the successful for the first phase, you can see the price started to decline very significantly. So this is actually one of the things that a lot of investors and owners stay out of business. Yeah. Any questions? Any? All right. So as I said, there is always challenge between value of weighting and value of adoption, and at some point we get to that optimal time. So this is a high level of.
If you can, okay, let's just okay. You can. You sure of?
Tech, is there any question? Okay, good. Thank you. So this is the improvement of the risk profile for investment that I was talking about. That's something which is basically looking at the expected value of delaying an intervention. So the advantage of that solar ready versus solar. So when you see on this particular example that this is a cumulative risk profile, the S-shape function that you have for the investment or the value at risk, if you will. So you can see something that would otherwise would not be profitable. If you go with the solar ready, which minimize the cost of conversion, that would be an amazing investment that you have in the place. So 2 points from the policy. One is introducing any of these options and flexibility into the design, but most importantly, you want to look at targeted policy intervention. So this is a case that you would justify investment from the public sector as far as incentives, as far as, we see like in this case, maybe there is a 17,000 difference. So why not we split that cost with the private owner? Why not we motivate them? Because we know that is all not about the cost. There are other triple financial bottom line that you would deal with that. But, at least help them target it into this particular areas. So we created an engine that's can be deployed into the Energy Plus. We work again with the Professor Agenbro's, late Professor Agenbro's team, and this was for the stage energy investment. And the part of that is, let's look at the building energy demand. Let's look at the future of the electricity price, technology costs, and we are looking at the multi-stage investment. For instance, even with the solar, you don't have to go all the way. So you can stage that into 2 or 3 type of investment, particularly if the scale is high. Rather than deploying it in once, you can have series of different technologies at different price tags and deploy that over time. The other thing is, particularly we introduced the buyback price, like the kind of things that going around that, and there's uncertainty around it because it depends on the grid and the grid capacity and all of the other sort of sometimes even political discussion in that state, in that jurisdiction. So there's uncertainty about the payback. So if you want to sell back price to the grid, the combination of that with the uncertain demand and uncertain price, that can play a role. So we're defining an optimal investment strategy by looking at all of that, and particularly at the core of that would be an Energy Plus engine, which is used for the building energy performance. So this was an example of the solar ready. I'm going a little fast because I'm getting a little bit over my time. So this shows the 2 region based on the price that you anticipate. Yes, if you're in the regime that's paying 20 cents per kilowatt hour, 15 cents per kilowatt hour, yeah, it's more motivations there, more incentives to deploy that immediately. But otherwise, if you are in the low price or not rapidly increasing, then the threshold of investments would be much lower for your case, and therefore you would delay on your whatever energy intervention you might have on your mind. So that's likelihood of adoptions, and particularly these numbers are a little old, pull it from one of the publication we have around 2014, 2015. So the numbers and the likelihood needs to be updated, of course, but it wants to show that a lot of times you you would get to the area that, maybe a lot of these technologies are not getting deployed simply because of the fact that likelihood of adoptions is not that high, because of the numbers is not working on your behalf. The numbers are not working, and you are either in the low price regime, there are not enough government incentives, the sellback price to the grid is not at that level. There's so much uncertainty around that. So therefore, a lot of people are staying away from that market. So these are the policies that needs to be targeted for those. So revisit of that risk profile, cumulative risk profile, and the added value. So let me sort of, summarize that. The kind of things I wanted to talk about that, and hopefully some point takeaway here, is thinking of that as more of a modules, energy efficiency, energy conservation measures, and renewable energy should be sort of a plug and play. That should be a mentality. The timing of investment needs to be part of that, and also the scale. So you don't have to go all the way. And the reality, the investors, the owners don't go all the way. And the method needs to be capturing that. So the real options approach that we propose here, capturing that. However, there are issues, there are barriers in terms of, some of the biases investors have. Some of these policies that are not working, not effective as much to gap the investment that we see here, the investment gaps into some of these systems. This is the abatement curve. Some of you might have seen, I borrowed that from McKinsey report, and it's more of a global, and numbers needs to be updated, but they were talking about the whole transition could be without much of a overall investment. Like, it's going to be really positive if we deploy them in a right order. And I kind of like that, because this is something that the method of real options and portfolio analysis can help. So you can start with some low-hanging fruits, like on your lighting. And if you have an account to deposit that saving or get into the energy performance contracting, like the kind of things that now subsidiaries of Tesla is doing in California, they come and lease a space from owners, commercial and residential owners. They provide the assets, in this case, photovoltaic system and energy infrastructure for that. And then they let you as a users, as an owner, to take advantage of that. So they pay upfront cost of, $20,000, $30,000, $40,000, and you would benefit from that. And anything left, they sell it to the utilities and gain the profit. So energy performance contracting, we have some examples of that across Georgia Tech campus. I wish we see more of those, because we can start with some low-hanging fruit and then get into some bigger items, bigger ticket items, and even go for replacing the roof, replacing the whole HVAC systems, water heaters, and other things. But you need to have sort of an escrow account, if you will, which basically that escrow account would get the saving, and you probably accumulate some interest on that. Then you can invest in something more expensive down the road and totally elevate the state of energy performance on the building. So couple of publications that I pulled out, you would see more of a calculation, the dynamic programming part of that, and sort of the nuance of the volatility estimation. So you can see on those two publications. And with that, I'd like to open up for some conversation, some discussion.
Thanks, Baabak.
Thank you.
If anybody online has any questions, go ahead and raise your hand, or you can put them in the chat as well. Yeah, Kevin Caravati.
Sure. Hey, Baabak. For those of you who don't know, Baabak and I worked together on a project, probably goes back about 12 years ago, on the reduction of the balance of systems for solar components. That was everything but the panel. And Baabak, your work there was really important. And we're seeing that same type of price reduction across the board now for batteries. And, we're very early into hydrogen. So I think your models there are going to be very important going forward. So great work. I was just on a call earlier today with the Department of Defense, who are working with NREL, Department of Energy NREL, on all of these issues. And you brought up some barriers, and with reference to Dr. Brown's slide, one big institutional one is, can the grid handle all the new EV and mobile charging and renewables coming on into the market? And the second one related to cybersecurity, which kind of was we've sort of on the periphery, because this generation of all this data opens it up to people getting into systems. And so the cybersecurity community is often, there's a lot of unknowns for them. So their first reaction is, no, we can't do all these things that you would like to do. So that's, it'd be interesting to include that in some of your evaluation. But terrific work, and thank you so much.
Thank you, Kevin. Yeah, you remind me some of the good collaboration we had around that balance of system. And I'm glad you mentioned NREL. Continued working with them. They have a group that kind of piggyback on some of the great work GTRI has done. And I'm serving as the advisory capacity for them. And they're really taking the innovation that Georgia Tech put into the market. And now they're deploying that at a massive scale in order to bring the BOS, the balance of systems cost down. And it's probably, and now that you were talking about, that was one of the, probably could be considered as an IP issue too, which is, Georgia Tech provide that to the federal government, and now that through the NREL, they're deploying that across the board. So they have done lots of, the time and motion studies and lean manufacturing, lean construction methods applied to that. Yeah, I'm glad, that one was one of the real successful projects that I got a chance to play a small part of that. And I noticed that significantly brought down the Georgia Tech design, the GTRI deployment, significantly brought down the barriers in terms of adoption of that into the market. Yeah, good point. And yeah, please include me in any conversation you think I could play a role on the hydrogen fueling station. And, to be honest with you, Kevin, these things coming to the states and communities, which they have no idea about how these things work. And now, even between hydrogen and electric vehicles, I don't know. I mean, honestly, I don't know. We are seeing a giant like Toyota staying on the sideline for the EV, and they have massive technology that they're deploying on the hydrogen side. And I'm just talking about the regular cars. I'm not talking about the commercial vehicles, which is, the batteries, it's maybe a little stretch. I know we all saw Elon Musk on top of his big trucks and all of that, but, it's quite a stretch because of the physics of the system. You mentioned that, from the Department of Transportation side, there is a huge concerns that these trucks, electric trucks that are probably 20 to 40% heavier. Now 18-wheelers comes to the roads. I mean, you can't imagine the damage it would have on the roadways and pavement system. So that's another issue. We are dealing with the extra weight and extra damage on the roadway too. So it's pretty interesting to think about some of these emerging technologies. And I'm glad, the talk about the cybersecurity, which I know little about that. That's another issue. Yeah, good point. Very good point.
We have a question here in the room. Yeah.
I just had a quick question with regards to, slide 20, and more in the context of infrastructure and versus the sustainable infrastructure. They're well-known risks, well-known ecosystem that supports the present infrastructure. Could you kind of speak to perhaps maybe any regions, like maybe Germany or Nordic regions, how they've buttressed that, how they've created like an insurance scheme and so on and so forth to kind of mitigate many of the risks to make another case for sustainable investment or sustainable finance. I know there's green bonds, all these different things. Can you speak to that?
Again, I'm not sure whether I have the whole answers, or I'll try, what my understanding. One of the thing is, of course, the Germany decided, and the part of the balance of system projects that Kevin referred to, that there was something related to the modules that we know the modules eventually becomes a global supply chain, becomes commodity, so the price was going down. But the balance of system costs in Germany was 4x back in late 2000 compared to what we have in the US. Part of that was workforce training. Part of that was the industry was not there. The other parts that we noticed in the US, and you compare that with other countries, especially the European countries, on the residential side, roofs are really complicated in the US. We have all shape and changes of the roofs compared to what you see in some other countries in the Europe. So that was another challenge. So that requires a new type of installation and for the rooftop PV systems. The other thing was at the national level, Germany decided to kind of retire some of that nuclear power plants, not building new ones for sure. I know that some of those changes ever since the Russia and Ukraine war, that was another issue. But yeah, I mean, there was a very top-down incentives from German government to go net zero, much stronger than the commitment that we have in the US. And part of that was huge mandates into renewable energy deployment for residential homes in Germany compared to the US, which we still do not have it at that level that Germany had. And the price of electricity, retail price of energy was much higher. I mean, especially when you compare Germany, the only parts of the country that might come even close to them would be like maybe the price in California or some state that have significant environmental sort of cost embedded into the price of electricity and price of gas. So that was another issue. So naturally, if you are in the place that the price is much higher, that's a motivation for more immediate investment. So these are some observations. But I know I probably did not completely answer your question, but these are some of the significant differences that we saw between the two countries, particularly when we did that balance of system project with Kevin and his team at GTRI. But any comments you might have, please.
Let me word it differently, in the sense of like insurance companies underwriting sustainable infrastructure. Like if you look at what they write many things about how much they support sustainability. But when you look at, again, because maybe it's an opaque industry, what actual things are like really large institutional investors doing other than, to incentivize or catalyze? I'm aware of like there's concessional financing with the World Bank and so on and so forth, but are you seeing anything in the private sector where the insurance companies that have a large balance sheet, but the risk involved in underwriting many of these new sustainable infrastructure is not really known? So it's kind of like a really interesting risk profile, especially as interest rates rise. So, but they have
very good point.
So they have all of the wealth to influence like accounting regimes in their own countries, but it doesn't seem like that's happening. And I was wondering, is it happening? Because again, like you said, it's a very opaque industry and you really can't tell what the insurance prices are doing in infrastructure or anything like that. So you can only go off of a 10K or what they say in a conference or something.
No, very good point. I we recently started a project for the U.S. Department of Transportation looking at some of these green financing options. Overall, you're absolutely right. I think particularly in the U.S., they are really behind on that. As a matter of the fact, in contrary, they penalize some of these sustainable investments, particularly sustainable buildings. I talked to folks at Moody's and S&Ps, and they appear in some of the green building conferences or transportation infrastructure type conferences. And one of the things they would say, and there was a question on the floor when somebody from Moody's presenting. And by the way, they're not talking generally about anything. They would say, we evaluate each project based on the merit of that project. So they're not providing any blanket. And they said, if you are interested in evaluating and get the investment grading on the project, you have to come and pay the fee, pay the appraisal, and we do that. So that's their model. But after that, the disclosure, he was saying a lot of communities, cities, municipalities, board of regions, like state of Georgia, when they come with some of these bonds for sustainability and infrastructure, sustainable infrastructure, sustainable building, particularly he singled out higher education. They said they tend to grade them low. And the reason is they believe there is not enough merit there as far as energy performance, as far as energy saving, as far as renewable energy production. So they strongly believe there is no premium as far as that real estate. Like, for example, again, I'm not singling out, but, let's say Candida. They believe that the reason, and this is not me talking, this is somebody from Moody's that I listened to him, and I had a conversation after that session with him, extensive conversation, disagreeing with him, but that's what he was saying. If Georgia Tech goes or Board of Regents goes, we have the idea of the Candida, they tend to bring it down because they believe these projects are more about marketing efforts. These projects have more intangible benefits rather than tangible benefits. So yes, to your point, unfortunately, the insurance appraisals and these investment grading grades, they are not big fans of energy efficient type buildings unless it's proven that provides significant financial values. Because, and particularly for higher education, they believe universities do that because they are in the severe competition with one another. They want to open the next green building, the next green space, because they want to attract a fewer number of students, scholars, and other things. So it's more of an intangible. One can argue that somebody can put a price on that, but they said if it's just on the merit of energy efficiency, we cannot really grade them high. So that's what I heard from them, and I'm not necessarily in agreement with them, but that's what is happening, unfortunately, here. But yeah, I mean, I think you're absolutely right. The way accounting works needs to be influenced. Yeah, needs to be changed. And I would say to Beryl's point that we need to provide data for them. We need to measure these things, and hopefully with this IoT deployment, we should show that, yeah, I mean, this is not just about attracting undergraduate students or maintaining talent at Georgia Tech. It's more than that. It's about healthy buildings. It's about, that building acts as a momentum for some other things. So we need to show these are not secondary benefits. These are actually primary benefits. And that has been challenging. That has been tough, I have to acknowledge. Yeah. But good point. Very good point. Yeah.
Baabak, I want to thank you for giving us a really great talk today. I think we could probably go on for another hour, but or more if you'd permit us. But I think we better call it a day. And hope that all of you will rejoin us in 2 weeks' time. We'll have another talk from Professor Dylan Brewer in the School of Economics, and perhaps we can carry on the conversation at that point. So thank you again, Baabak, and appreciate it.
Thank you.
Thank you for giving me the opportunity. Thank you, everybody. It was very good, conversation. Thanks.